You walk into a car dealership. You pick the car you want. You sit down at the desk. The salesman types something into his computer. He looks at the screen. 1 second too long. Then he looks at you. Differently. Not hostile. Not cold. Just different. What he saw on that screen was a 3-digit number. And that number told him more about how this conversation was going to go than anything you could have said out loud. That number changes how much you pay for cars, apartments, insurance, even loans. And most people don't realize it's quietly costing them thousands every year. Bankrate ran a study in 2025. People with low credit scores pay around $3,400 more per year than people with good credit. Just a different number on a screen. By the end of this, you'll know exactly why. One thing before we start, this is educational. Nothing here is financial advice. For anything specific to your situation, talk to a licensed professional. 5 levels. Let's get into it. Level 1. No score. You don't have a bad score, you have no score. And the system treats those two things as basically the same. Lenders need data to price risk. You have none. So to them, you're an unknown. And unknowns are expensive to bet on. Here's what that looks like in practice. You're looking for an apartment. The landlord runs your credit. The screen comes back empty. He calls you. I'm going to need double the security deposit, he says. Not because your history is bad, because you don't have one. You need a car for work. You don't have $15,000 in cash, so you need a loan. The dealer runs your credit. Nothing comes back. I'm going to have to give you a higher rate, he tells you. Not because you're irresponsible, because you haven't been in the system long enough to prove otherwise. Doesn't matter. That's the first thing the credit system teaches you. The absence of history is itself a liability. There is no neutral starting point. You begin already behind. And here's what that actually means. You are not being evaluated yet. You are being charged for the privilege of not being evaluated. Now here's where it gets worse before it gets better. Level 2, poor score. 300 to 579. Now the system knows who you are. It just doesn't like what it sees. A missed payment from 2 years ago. A medical bill that went to collections without you knowing. A maxed out card from a stretch when things were tight. The system recorded all of it. No context. No reason why. Just that it happened. You try to get a credit card. 2 outcomes. Either you're rejected outright or they offer you a secured card, meaning you put your own money down as collateral and the bank lends it back to you with interest. This is legal. This is normal. This is the entry point. Now here's the one most people genuinely don't know. Car insurance. In most states, insurers price your premium partly based on your credit score. Lower score means a higher bill. A 2026 Insurify analysis found that drivers with poor credit pay around $2,600 a year for full coverage. Drivers with excellent credit pay $1,853. Same policy. That's $750 a year. Not for crashing, not for speeding, just for the number. And that's just one line item. Add the higher rates on loans, the bigger deposits, the apartments you don't qualify for. The penalty doesn't hit one surface. It hits all of them at the same time. The system isn't personal, it's statistical, but statistics still create winners and losers. And at this level, you are consistently on the wrong side of that calculation. Stay with me, because level 3 is where it starts to feel deceptively okay. And that's actually the most dangerous part. Level 3. Fair score. 580 to 669. You're in. Barely, but you're in. The secured card is probably gone now. You can get a real credit card. The limit is low, somewhere between $500 and $1,500, and the rate is high. The Fed's current data puts this tier at 24 to 28% APR. Some subprime cards push up to 36. The auto loan goes through too, but here's where it gets interesting. Experian's 2025 data shows borrowers in this score range paying around 13% on a new car loan. People with good credit pay around 5%. On a $25,000 car over 60 months, that difference works out to somewhere between $6,000 and $8,000 in extra interest. Silently, buried inside a monthly payment that doesn't look that different on the surface, that's what this level feels like from the inside. Almost normal. The card works. The loan went through. The apartment application came back fine. But the penalties didn't go away. They just stopped showing up as rejections. Now they're baked into the numbers themselves. You are not being turned away anymore. You are being quietly overcharged. And the difference is this: rejection you notice. Overcharging you don't. This is the level where most people stop asking questions. And that's exactly why they stay here longer than they need to. Level 4, good score, 670 to 759. Something shifts here, small but real. The rates in the advert start actually applying to you. When the car commercial says financing from 5%, you can get somewhere close to that now. Bankrate's 2026 figures put the average new car loan at around 7%. With a good score, you're getting under that. Your credit limits start climbing without you asking. A card you opened at $1,500 quietly becomes $4,000, then $6,000. You didn't request it. The bank is giving you more room because your history shows you don't need it, which is a strange kind of logic, but that's how it works. A mortgage is a real conversation now, not a wishful one. You'll get approved. Not at the best rates, but you'll get there. And that rate gap matters more than it looks. On a 30-year loan, half a point of difference adds up to tens of thousands of dollars over time. What this level gives you is access. Genuine functional access to the products most people use to build any kind of financial stability. For the first time, the system is treating you the way it was always supposed to. That's not a reward, that's just what normal looks like, and reaching this point usually takes longer than most people expect. But level 5 is something else entirely, and most people don't even know it exists. Level 5, very good to exceptional, 760 to 850. At this point, the banks want you, which sounds strange, but that's exactly where you are. They need you more than you need them. Experian's 2025 data puts borrowers above 781 at an average of 4.66% on new car loans. Borrowers with poor credit are paying 16. Different number, different world. The things arriving in your post aren't standard products anymore. Sign-up bonuses worth $500 to $750. 2% cash back across the board. Travel cards with lounge access and annual spending credits. None of that is generosity. It's what it costs to land a borrower profile the bank actually wants. Low risk, high engagement. That's you now. And that combination gets rewarded. Not because they like you, but because keeping you is profitable. Above 800, credit stops being something you think about. You apply for things and they come through. That sounds unremarkable. But if you've spent time at the lower levels, at where every application meant a wait and every wait meant a rejection, you know that unremarkable is not nothing. You're not a risk to manage anymore. You're a customer worth keeping. Now let me tell you the part nobody actually talks about. Remember that $3,400 from the beginning. That's not a one-time charge. That's every year, for as long as the score stays low. 5 years, that's $17,000. 10 years, $34,000. Not from fraud, not from bad decisions, just from a number most people were never taught how to build. Inside a system that was never designed to make building it easy. The credit score gets presented as a neutral measurement, just data, just maths. It isn't. The person who missed a payment because the medical bill landed the same week as rent gets the same mark as someone who just forgot. The recent graduate with no history is treated the same as someone who defaulted. The immigrant who spent 20 years building a spotless record in another country starts from zero here. The system measures what it measures, but it cannot measure why. And most of the actual story lives in the why. If you're somewhere between levels 2 and 4 right now, you're not stuck there. You're just paying for information you haven't learned yet. That's a solvable problem. What understanding this gives you is clarity. And clarity is how you stop bouncing off a system and start moving through it with intention. That's the only kind of leverage most people have. Use it. If this was useful, subscribe. We break down how money systems actually work and how to use them better.